Hello, everybody, and welcome to exercise 10-11. These are entries for equipment acquisitions. So Getz, engineering, if any of you have seen the movie Chinatown, which you have not, you'll understand where that comes from. Purchased, I didn't write it, but I'm just telling you about that movie. It's not bad. Getz, it's classic. Getz Engineering Corporation purchased conveyor equipment with a list price of $10,000. Presented below are three independent cases related to the equipment. Okay, let's look at letter A. So these are three independent things. So, and it's asking us to prepare the journal entries required to record the acquisition and payment in each of the independent cases above. So Getz paid cash for the equipment 8 days after purchase. The credits terms were 2/10 net 30. Assume that equipment purchases are initially recorded at gross. So I received the equipment. So I'm going to be debiting equipment over here for 10,000. And then I'm going to credit accounts payable for 10,000. On day 8, the amount of cash that I'm paying to settle the account payable is going to be, because I'm paying within the terms, is going to be 10,000 at 98% of that amount, or the 210 and 32% discount in 10 days. The full amount's due in 30 days. The account payable gets written off at the full amount because I'm taking advantage of that discount. Now, when we go over here, what is going to be the credit? The credit is going to be to equipment for 200. We're going to reduce the carrying amount of the equipment for the discount. So that's how we go through and complete letter A. Okay, so again, purchased equipment on account, paid for equipment. Okay, so that is letter A. Let's now take a look at letter B. Okay. Getz traded in equipment with a book value of 2,000, initial cost 8,000, and paid 9,500 in cash 1 month after the purchase. The old equipment could have been sold for $400 at the date of trade. The exchange has commercial substance. Okay. So when we're looking at this particular one here, I'm just going to go ahead and hide this momentarily. So when I look at letter B, okay, and I kind of got messed up on this one first. But when we say that equipment has a book value of 2,000, an initial cost of 8, what does that mean? Well, the cost of the old equipment was 8,000. My carrying value of the old equipment was 2,000. So my accumulated depreciation on the old equipment is going to be $6,000. Whenever we're going through and doing a sale or a trade-in of an asset, what we need to go through and do is we have to look at this equation. And this is what I always share with my students in terms of, this is a journal entry you want to memorize. So if I have a loss, well, so let's go to start with the easy part first. When I take equipment off of my books, right, if I look at this over here, so when I have equipment, so on my books right now, I have equipment, and then I'm going to have accumulated depreciation on equipment. Okay, so this is 8, and this is 6,000. How do I know it's 6? Because the net book value is 2. So when I'm going through and doing this, I need to take the old equipment off of my books. So I need to debit accumulated depreciation on the equipment over here for 6. And I need to go through over here and credit equipment over here for 8,000. What I would typically do if I'm selling equipment, I would also be receiving some cash. And this is not the case here, but I'm just kind of going through this. So what we would then do is we would then say, okay, I would be getting over here, have a loss, balancing. And then over here, I would have a gain, balancing. So what you always want to do when you have one of these types of questions is you always want to take the old equipment off the books first, because that has to come off. So let's take a look at this over here. Let's go through the rest of this amount. go through the rest of this. So Getz traded in equipment with a book value of 2,000, initial cost 8, paid 9,500 in cash 1 month after the purchase. The old equipment could have been sold for $400 at the trade-in date. Has commercial substance. So if I went over here and I basically said, okay, cash, I'm paying 9,500. And at the same time, right, because I'm acquiring this, at the same time, I'm receiving new equipment. And we said that that new equipment is as a list price of 10,000. So I got new equipment. We said that that's worth 10,000. And then over here, I had to take the old equipment off my books and I'm paying cash. Those are all things we know over here for real. Now, the issue comes in where I have to say is like, okay, I have total debits of 16, total credits of 17,500. And so when I'm going through and looking at this, I've got a $1,500 balance. So your book is doing something a little bit differently. It's saying that the old equipment could have been sold for $400 at the date of trade. And so what your book is saying is that, well, what the new equipment should really be valued at is going to be the cash paid plus the value of the old equipment, or right over here. And if you remember what I was talking about previously, where we had debit to we're going to have accumulated depreciation equipment, and then whatever over here, we have our gain balancing or a loss balancing. Okay, so right over here, the problem is that, so the book is showing you over here that the new equipment is 9,900. If that is the listing fair price, I would probably instead say, okay, and what the book is trying to say is that the real true cost of the equipment is going to be the cash plus the value of what's been given up, or this 2,000 book value, which is really 4,000. So your book is valuing Kieso they're saying this is here as 9,900, but I think though that if the equipment is truly worth 10,000, or if that's the list price, then that's what you would record it at. So I'm going to depart here from what the book is saying. Now, what I do agree with the book on is that when you have this part right over here, my equation does not balance. I'm off by 1,500. So in this case here, this is going to be a loss on disposal of equipment. That's what I would call it. So the way your book is going through this is that they're saying that because the old equipment could have been sold for $400 at the date of trade, what you're really saying here is that, well, the true value of this new equipment is really not going to be 10,000, but it's going to be 9,900, or that 400 plus a 95. The same thing goes over here. You still have to take the old equipment off the books. And this part here is not changing. What does change is you're recognizing a loss on the disposal of equipment over here for 1,600. So this is the way that Kieso is going through and doing it. They're saying that you should be valuing the new equipment at the $400 is what it could have been sold for, plus the 9,500 cash, because they're saying that that's better than a better value than the list price of 10 grand. Now, what I would say is, well, if it's a list price of 10,000, it's a list price of 10,000. If that's what they're selling for, that's probably what the value should be. So that's how I would go through and do it, but I could be wrong. But I think that the dollar amount that we're coming up with for the loss is relatively immaterial. And if this is a fair value, a fair way of determining the value, if the machines are selling for that, then I don't really see what the issue is. But I would accept it either way. In any event, it's so immaterial that, and what do I mean by it's immaterial? Well, if I'm taking the amount of my loss is basically the difference is $100. The value of the equipment's 10,000. So you get a difference of about 1%. So again, you could do it. I would accept either way. In any event, this would be something that if you had to, you'd have to go through and then have a further discussion. Okay. So Getz gave the vendor a $10,800 zero interest bearing note for the equipment on the date of the purchase. The note was due in 1 year and was paid on time. Assume that the effective interest rate in the market was 9%. Okay. So in situation C, we have this $10,800 zero interest bearing note for the equipment on the date of purchase. So how would this work? Well, 10,800, we know that if we have a zero interest bearing note, that is not the reality. Okay, so to figure out what is this 10,800 worth today, if I take almost sounded like Australian there. If I take the value today, if I take 10,800, which is a year from now, and I divide this by 1.09, the value of this today is 9908. How do I know that that's correct? Well, if I take 9908, I multiply that by 9%. When I add these two together, it should give me the value 1 year from now. So when I go through and record this sale, right over here, I'm going to debit equipment for 9908. I'm going to credit note payable for 10,800, and then I'm going to debit discount on note payable. And this here is going to be 892. Okay. So that's what I'm going to do when I go through and initially record the transaction. So what happens when this is paid? Well, a year from now, I know I'm going to be paying out cash of 10,800. I'm going to be debiting note payable for 10,800. But then again, over here, the other part of this I have to do is that now that I'm paying off the note, I need to get rid of the discount. So this is going to be a debit to interest expense for 892. And then I'm going to be going through and crediting the discount on note payable because now I've paid this off. So your book actually combines this into one journal entry. You can do it either way. I'd accept either answer, but it's important that the equipment's really not worth 10,800 if I'm giving a zero interest bearing note. So if I have this zero interest bearing note, I know it's not for real. So I have to discount that back to today. How do I do this? Well, it's only being paid 1 year away from now. And so if I was to go through and to look at this in terms of a present value of a dollar table, and let's make this bigger, see what it gives us. Oh, perfect. So right over here, I've got one period at 9% or 0.91743. So if I come over here and I take 0.91743, if I multiply this through, I'm going to get 9908. So by dividing this by 1.09, this is the same value that you're going to be getting on the present value table. So that's the way that I would go through and solve this particular one. You do not need to use the present value table in this situation. Rather, it's that's how you would go through and do it. Wow, I love I'm asking if I need help with accounting. That's perfect. I think I do. So in any event, I want to thank you all for joining me here today on yet another accounting journey, and that was exercise 1011. Have a great day.